If you need your credit score to go up and you need it to happen fast, this video is exactly what you're looking for. I'm going to walk you through the 5 fastest, completely legitimate ways to raise your credit score. The kind of fixes that can show real movement within a single billing cycle, not vague advice that takes years to matter. And at the end, I'll answer the questions people always ask me about this, so stick around for that too. Before we get into the 5 fixes, it's worth understanding why some changes move your score fast and others move it painfully slowly. Remember, your score is built from 5 weighted factors, and the 2 heaviest ones, payment history at 35% and credit utilization at 30%, are also the 2 that can change the quickest because they're recalculated every single time your credit card issuer reports new information to the bureaus, which is usually once a month, right around your statement date. Length of credit history, on the other hand, can only move slowly because it's literally measuring time passing. There's no shortcut for that one. Credit mix and new inquiries barely move the needle in the short term either. So if you actually want fast results, you need to target the 2 factors that update on a monthly cycle. That's exactly what these 5 fixes are built around, and that's why they work faster than almost anything else you'll read online. iFix number 1, and the single fastest lever available to almost everyone. Pay down your credit utilization before your statement closes, not before your due date. Here's the part most people don't realize, and it trips up even people who think they're being financially responsible. Your credit card issuer doesn't report your balance to the bureaus at the end of the month, and it doesn't wait until whenever you happen to pay it off. It reports your balance on your statement closing date, which is often 10 to 25 days before your actual payment due date. This means you could be someone who pays their balance in full every single month, in good faith, and still show up with high utilization on your credit report, simply because of when that snapshot was taken relative to your spending. Let's put real numbers on this. Say you have a credit card with a $2,000 limit, and throughout the month you spend up to $1,200 on groceries, gas, and bills. If your statement closes while that $1,200 balance is sitting there, your reported utilization is 60%, even if you pay the entire balance off 2 weeks later before it's due. 60% utilization is genuinely bad for your score. Now imagine instead you pay that balance down to $150 a few days before the statement closes, then let the statement generate, then pay whatever's left before the due date. Now your reported utilization is under 10%. Same spending, same eventual full payment, completely different number reported to the bureaus. The fix is simple. Find your statement closing date in your account settings and make a payment a few days before that date so your balance is low when the snapshot happens. This single change alone can raise a score by 20 to 60 points within one reporting cycle for someone who was previously carrying high balances at statement time. Fix number 2. Ask your credit card issuer for a credit limit increase. This works because it directly improves your utilization ratio without you having to pay down a single additional dollar of debt. Going back to our example, if you have a $2,000 limit and a $600 balance, that's 30% utilization. If your issuer bumps your limit to $4,000, that exact same $600 balance is now only 15% utilization, and your score can respond within the next reporting cycle, sometimes within just a few weeks. Most major issuers let you request this directly through their app or website in under 5 minutes, and many of them will do what's called a soft pull to evaluate the request, meaning it won't even create a hard inquiry on your report. A few issuers do use a hard inquiry for limit increase requests, so it's worth checking their policy first. But for the ones that use a soft pull, this is essentially a free utilization boost. The one catch, and it's an important one, this only works if you don't treat the new limit as new spending money. The entire benefit disappears and can even reverse if your balance grows right along with your limit. Fix number 3. Become an authorized user on someone else's account. If you have a parent, spouse, partner, or close family member with a long-standing, well-managed credit card, meaning low utilization and a genuinely perfect payment history, ask them if they'd be willing to add you as an authorized user. You don't even need to use the card yourself for this to help. In most cases, that account's entire history, including its age and payment record, gets added to your credit report almost immediately after you're added. This can meaningfully boost your score, especially if you have a thin or short credit history of your own, because it's essentially borrowing years of positive history overnight. This is one of the fastest score boosts available anywhere, sometimes showing results within the same reporting cycle, occasionally even within 1 to 2 weeks. The important detail here, and I really want to stress this, it only helps if the primary account is genuinely well managed. Being added as an authorized user on an account with high balances or a history of missed payments can absolutely hurt your score instead of helping it. So this only works with the right person and the right account. Fix number 4. Dispute errors on your credit report. This one surprises people every time because most people assume their credit report is accurate and never bother checking it. But errors are far more common than you'd think. A payment marked 30 days late that was actually paid on time, an account that isn't even yours due to a mix-up with someone with a similar name, a collection account that should have aged off your report years ago, but is still sitting there. You're entitled to a completely free copy of your credit report from all 3 bureaus through the official site, annualcreditreport.com. This is the only site mandated by federal law to provide it for free, so be cautious of lookalike sites that try to upsell you. Go through your report line by line, and if you spot something wrong, you can file a dispute directly with the Bureau online, usually in about 15 minutes. By law, the Bureau generally has 30 days to investigate your dispute. If the error gets corrected or removed, your score can jump immediately once it's updated, sometimes significantly, especially if the error was a false late payment or an account that genuinely wasn't yours to begin with. Fix number 5. Pay down balances strategically before the statement date, but do this across every card you own, not just one. This builds directly on fix number 1, but applies it at a portfolio level. If you have multiple credit cards, your overall utilization, meaning your total balances across all cards divided by your total available credit across all cards, matters just as much to your score as any single card's individual utilization. Before each statement date across all your cards, get every single balance as low as you realistically can. Some people take this a step further and make a mid-cycle payment specifically timed before the statement closes, purely to manipulate the reported balance downward, even though they're nowhere near their actual due date yet. I want to be clear that this isn't a loophole or a gray area trick. It's a completely legitimate strategy that simply takes advantage of how the reporting timing already works, and plenty of people with excellent credit do this as a matter of habit without even thinking about it. So how fast will you actually see results from these 5 fixes? The utilization-based fixes, numbers 1, 2, and 5, typically show up within 1 billing cycle, so somewhere between 2 and 6 weeks, depending on exactly when your statement closes relative to when you make the change. Becoming an authorized user can show results even faster, sometimes within 1 to 2 weeks, since it isn't tied to your own billing cycle at all. Disputing an error depends entirely on how long the Bureau's investigation takes, but once it's resolved in your favor, the score change itself is usually reflected almost immediately. I want to set realistic expectations here. None of these fixes will turn a 500 score into an 800 overnight, and if anyone promises you that, they're not being honest with you. But for someone with an already decent payment history who's simply been held back by high utilization or a thin credit file, these 5 fixes together can realistically move a score by 50 to well over 100 points within 1 to 2 months. Let me walk you through what this actually looks like combined, using a realistic example. Imagine someone starting at a 620 credit score. They have two credit cards, one with a $3,000 limit and an $1,800 balance, and a second with a $1,500 limit and a $900 balance. That's a combined utilization of exactly 60% across both cards, which is a major factor holding their score down, even though they've never missed a payment in their life. In month one, they identify both statement closing dates and pay each card down to roughly 10% before those dates hit, meaning around $300 on the first card and $150 on the second. They also request a limit increase on their older card and get bumped from $3,000 to $4,500 purely because they've been a reliable customer for 2 years. By the time the next statement cycle reports, their combined utilization has dropped from 60% to somewhere around 8%. In the same month, they ask a parent with a 15-year-old credit card and a flawless payment history to add them as an authorized user. That account alone adds over a decade of positive history to their file. 2 weeks later, while going through their credit report from annualcreditreport.com, they also notice a collection account listed that was actually resolved and paid off 2 years earlier, but never got updated. They dispute it, and 3 weeks later, it's removed entirely. Realistically, a combination like this, dramatically lower utilization, a limit increase, an authorized user account, and a resolved reporting error, can move a score from the low 600s into the low to mid 700s within about 6 to 8 weeks. That's the kind of compounding effect you get when you stack these fixes together instead of doing just one. Now let's cover a few mistakes that can quietly cancel out all of this progress, because I see people undo their own hard work constantly. Mistake 1. Requesting several credit limit increases or new cards all in the same week. Even soft pull limit increases can sometimes trigger a hard inquiry, depending on the issuer, and stacking several applications together in a short window signals risk to lenders, which works against everything you're trying to do. Space these requests out by at least a few weeks. Mistake 2. Paying down your balance right after the statement closes instead of before it. If you pay off your card the day after your statement generates, you've paid your bill responsibly, but you've done nothing for this month's reported utilization. That high balance already got locked in and reported. The timing genuinely matters more than people expect. Mistake 3. Increasing your spending the moment your credit limit goes up. This is the single most common way people sabotage fix number 2. The limit increase only helps if your balance stays where it was. If you immediately start charging more because you technically have the room, your utilization percentage barely moves or can even get worse. Mistake 4. Assuming a dispute will automatically go your way. Disputes are investigated, not automatically approved. You have a much stronger case if you have documentation, like a bank statement showing an on-time payment, rather than just claiming an error existed. Keep records of your payments for at least a year specifically for this reason. Before we wrap up, let me answer a few questions people always ask me about this topic. First, does closing a card I stopped using help my score? Generally, no. Closing a card removes its available credit from your utilization calculation, which can actually push your utilization percentage up on your remaining cards, and it can eventually shorten your average account age too. It's usually better to keep it open and simply not use it, unless there's an annual fee you genuinely can't justify paying. Second, will paying off a collection account remove it from my report immediately? Not necessarily. Paying it satisfies the debt, but the account can still remain on your report for up to 7 years from the original delinquency date, though it typically shows as paid rather than unpaid. These 5 fixes are the fastest legitimate path to a higher score that exists, and unlike vague advice you'll find scattered across the internet, every single one of these is something you can realistically start today, not someday. If this helped you understand exactly what to do next, subscribe. New credit and personal finance videos go up every week right here. And let me know in the comments which of these 5 you're starting with first, and what your current score is if you're comfortable sharing.